Good afternoon, Mr. and Mrs. Kessler. Hope you guys are doing great. Thanks for coming in today. How's your family, your kids and grandkids? Have you been able to spend much time with them? How about the lake house? Are you spending much time at your vacation home? Well, I know your time is very valuable, so we can just go ahead and hop right into it. You guys asked me to put together a financial plan that highlights several items. Your key goals were looking at your estate plan, make sure it's all buttoned up. What kind of exposure do you have from an estate tax perspective? You also asked that I look at your insurance. What should you be thinking about there? And is long term care something you should consider? Also, looking at your personal income tax, John, you recently sold the company. I know you've worked really hard to get to this point, and it's very exciting that you've done this, but what are the tax implications? And then lastly, knowing your risk tolerance, take a look at your portfolio to make sure it's diversified and fits all of your needs. Before we jump into those goals, I just want to do an overall review of your financials. Your balance sheet looks great. I've got a copy for you here, and I'll also send you an emailed copy so you have an electronic version. Um, you're doing great. You've got the installment note, which is going to be your cash flow for the next 7 years. You have very, very little debt. Just have the debt that's on the vacation home. And when you compare your current assets to your current liabilities, you're able to service those current debts, 47 times over, which is great. It means that you've got plenty of assets to look over your liabilities. One thing that I am a little bit concerned about is how much cash liquidity that you have. While you're sitting on a pretty large CD of about 600,000, your savings account and your cash is on the low side when you look at all of your cash outflows for the year. One thing we may want to look at is there a way that we can generate some additional liquidity for you? You don't have any debt on your personal residence. We may be able to finance that property, get you some additional cash, put it in an account that's going to earn a safe return for you, but it's going to give you immediate access to it. You never know when something's going to happen, medical bill, some sort of accident, something like that, and you just want to make sure you're covered from a liquidity standpoint. Also, you've got about, 940,000 in your stock portfolio, 2.9 in your mutual funds, and your retirement accounts between the both of you are just over 1.5 million. And then you've got the two life insurance policies, which do carry some cash value. We would be able to access that in the event you need something. But again, I think it's good to have some cash on hand. Next, I want to take a look at your risk management. Like I mentioned before, you wanted us to look at if long-term care is something that would be helpful for you. But I think there's some other pieces that we should touch on as well. First off, looking at your homeowner's policy, your fair market value of your house is $620,000. That's great. Your current coverage, though, is set up at $400,000. This is creating an exposure to you, which equates to about $35,000 on a $100,000 loss. This could be pretty significant if something major happens. Also, we looked at your vacation home. There's a little bit of exposure there, about $5,800 on a $100,000 loss. Both of these things can be fixed very easily with a conversation with your insurance agent. We looked at your personal auto policy, and you seem to be fairly covered there. But one thing I did want to note was you do have a boat, and I wasn't provided the insurance coverage on the boat. We'd want to look into this to make sure you're adequately covered. It's, the proper insured names are on the policy, and also just the coverage on it. Your health insurance, you've got, Medicare, you're covered on your hospital stays, regular doctor's visits, and your prescription drugs. However, you don't have coverage on your dental and vision. These may not be important to you at this point in time, but it's just something to consider. If you do want that kind of coverage, then we should look into a Medicare Part C policy. You don't have any disability, which is fine as you're both retired. But given where you are in life, now would be a good time to get some long-term care. You're relatively healthy, so we should be able to get the coverage fairly easy. And again, we can work with your current insurance agent or reach out to the market to see what kind of quotes we can get. Next, on your investment planning, we looked at both your portfolios, your stock portfolio and your mutual funds portfolio. You had mentioned that while you are in the what we would call spending phase of life, you are open to taking on a little bit more risk. After reviewing your stock portfolio risk beta is slightly your over a one, which means it is on the above average side for risk. Now, the beta is just a fancy term for risk of a stock. Looking at the mutual funds portfolio as well, you are also on a little bit above average for the risk portfolio, but given your input to us about okay with a little bit extra risk at this point in time, I would probably leave your stock portfolio alone. In the event you guys do change that, you've got some additional cash flow right now coming in from the installment note. So that's going to allow you to not put so much pressure on the investment accounts to take distributions. You're actually going to be probably adding to those accounts for the next 7 years. So once we get closer to that installment note being paid off, then we may want to change our approach in both of these accounts. The next thing we looked at was your retirement planning. Again, I know this wasn't a huge topic for you guys. You're both retired. You do again have the installment note income coming in, but John, you do have a 401k. Mary, you have a 403b. Both of these accounts, as a reminder, are tax deferred but are not tax free. So over time, as you take money out of these accounts, it is going to generate tax. Could be some capital gains, could be some ordinary income, and we would have to pay the tax on those withdrawals. You do have an option today, though. If you wanted to go ahead and realize the tax, we could switch those over to a Roth IRA. Then they would grow tax-free going forward. However, we would have to go ahead and generate the tax, so you'd be starting with a smaller amount in the account. You've both mentioned to me before that you're not too concerned about your retirement accounts and you're open to letting those grow and leaving them to your children. If that is still the case, then I would recommend moving forward with the rollover into a Roth IRA. One thing, John, we did notice on your account was that the beneficiary is the Salvation Army. Now, if something were to happen to you today, Mary and the kids would not have access to those funds. They would go to the Salvation Army. If those are still your wishes, then we can set up the Roth IRA to operate similarly. But if you do want those funds to go to your kids after your passing, then yes, let's go ahead and update those beneficiaries so they reflect your current wishes. Next, we looked at some income tax planning for you. This year, you've got the installment sale. We sold the company. That's great. John, as I mentioned, you've worked really hard and you to get to this point, and now we just want to make sure that we're not having to pay a whole bunch of taxes on the account, or on the installment sale. You did receive a down payment of 20%. So because of that, we are going to realize some taxes right there on that piece. What we can do and what your CPA will do is they'll look at your basis, which is basically, how much money do you have into this investment? And they'll allocate a little bit of that basis to the down payment. And then the rest of that will be treated as capital gains at the 20% tax rate. Since it's your business and you material participated in it, you shouldn't have to pay any net investment tax, but we will have the 20% federal capital gain, and then whatever the capital gain rate is in your state. From here on forward, because you did the installment note, it's going to defer those gains over a 7-year period. This allows you to not have a huge tax bill today, which is, nobody wants that. So we're going to be able to defer the remaining taxes due on the sale of the company over a long period of time, or over 7 years. During that time, Every year, we'll look to see what we can do to mitigate some of those taxes. Immediately, one thing that I see that we can take advantage of is that there is one stock in your stock portfolio that is carrying about a $218,000 loss. We could work with your wealth management firm to harvest those losses in a way that it can help offset some of the taxes that are being generated on the sale of the company right now. There are some nuances we'll have to work through, but I think this is a good solution to at least offset some of that income tax going forward. Another thing we can also look at is, if income tax is very important to you, is look in your stock portfolio and try to change the allocation to invest in things that are not subject to income taxes, like municipal bonds, things like that. If that's something you're interested in, then we can go down that route and see how we can reallocate the portfolio. Another thing we looked at, which is not a problem for today, but is something that we're going to have to consider for the future, is the large amount of unrealized gains that are sitting with the stamp that you inherited. Right now, we're estimating that there could be gain of about $681,000 with that stamp, and that's after assuming a 15% commission on the sale. When you decide you would like to sell that stamp, we need to do some planning ahead of time to see how we can mitigate those taxes as best as possible. Right now, I think we just let the stamp grow. And coming back to our previous conversation about your insurance, I want to make sure that that stamp is properly insured. Again, we weren't provided any documentation that said whether it was or not. It may follow under your homeowners, but given the value of the stamp and the losses in the homeowner's policy, it may be worthwhile to get a separate policy on that stamp just in case something happened to it. The next piece we looked at was your estate planning. Right now, you have a very basic estate plan tied up in just a will for each of you. While this is a good start, it does, it's better than not having anything. It does subject your estate to a lot of exposure and some additional administrative burdens that your family would have to handle after your passing. Right now, with just a will, all of your assets would be recorded. Your executor of your estate would have to go and file all of these paperwork with the court. All of your assets would be filed under public record, and anybody could go look at them to figure out what you owned. This is not ideal. You never know who can read those files and come, trying to take advantage of the family. Also, it leaves some room for arguments among children and grandchildren and other family members later if you're not very clear on how you want assets to move. What I would recommend is setting up a revocable trust structure. We would have one revocable trust for each of you. In this revocable trust, you can list out exactly how you want your assets to flow. I want these things to go here. I want this stuff to go to another person. And it also allows for these assets to be moved into trust. Whereas if you wanted to leave an asset to a grandchild, that may not give them access to it outright. It would give them the ability to enjoy it, but maybe you set one of their parents, one of your children, as their trustee. It's just going to give you a lot of control over what happens to these assets. And then it also puts into place something that dictates if somebody gets sick or has some other kind of medical struggle. There's language in here that can help take care of that. It also is going to keep your assets out of probate. We would use what we'd like to call a pour over will, which is just a basic one-page document that says, whatever's not in my revocable trust, I leave to my revocable trust. You will only have to file that one document with the courthouse. It won't list your assets in it. And the reason why it doesn't list your assets is because we've already put everything in the revocable trust. That gives you some privacy, and it's very specific to where your children, your grandchildren, other family members can't argue later in life about who gets what. The pour over wills and the revocable trust structure is really just an extension of you. So if there's any concern that I'm putting my assets in a trust, how am I going to get to those assets while I'm living? You just go get them. You're the grantor, which means you're the person who set up the trust. You're the trustee, which means you're in charge of the administration, and you're the beneficiary, which means you're the person who gets to enjoy the assets all during your lifetime. So there's really no change to your day as it stands today. We would put your personal residence, the vacation homes, your checking and savings account, your wealth management accounts, all of those types of items we would put into your revocable trust. The things that we would leave out are your retirement accounts. We do have to link those to you personally, but we could update the beneficiaries to the revocable trust. So, again, when something happens to you, those assets move into the trust automatically. The other thing we looked at were if you had any powers of attorney, which we weren't provided any. So we may want to make sure you both have medical and financial powers of attorney. That way, and if something happened to you, became incapacitated, then you would have somebody who could step in and make decisions for you. If you don't have these in place, then you have to go through the court system, which again is just some additional administrative burden for your family. And nobody wants to deal with that kind of stuff when you're dealing with a loved one who is having some sort of medical emergency. We also looked at the potential for an estate tax bill when both of you pass. Right now, the lifetime exemptions is set at 13.8 million. And you're asking, what is the lifetime exemption? What does that mean for me? What it means is you have the IRS gives everybody a certain level of assets that they're able to give away to their loved ones when they pass and not pay any estate tax. Right now, that's set at 13.8 for both of you. Your estate is coming in at about, between 13 and 14 million, which means you wouldn't have an estate tax problem. You could give all your assets to your family and you would not be paying that 40% to the IRS. However, on 1/1/2026, the law that dictates that 13.8 million apiece is sunsetting, meaning it's going away. Right now, we don't know if they'll increase it or not, but if it does decline, it would go down to about 7 million apiece. So 7 million plus 7 million, that's 14. That's right where you guys are at today. So again, even once the sunset happens, you may not have an estate tax bill today, but if you continue to grow your assets the way you have your entire life, we could end up having an estate tax problem. You've worked too hard to have to pay 40% to the IRS. So we can do some planning now that's going to help mitigate that problem in the future. One of the things that we looked at was, something as easy as utilizing annual gift exclusions. You're able to give $18,000 a year to every single person, so you can start gifting some assets away to your kids and grandkids today. That's easy enough to do. You could also set up what's called an ILIT, which is an irrevocable life insurance trust. This gets both of your policies. If we were to set up this structure, you could put both of your policies into this trust, have each of you be the beneficiaries of each other's trusts, and that way when the life insurance proceeds pay, it guarantees that they're not includable in the estate. We'd have to do a little bit of planning about getting those assets in there, either through gifts or sales. We won't get too technical today, but I wanted to introduce the concept to you to see if this is something that you may be interested in. Other thing is we could do some charitable donations to reduce the estate. This could also impact your income tax questions that you provide or presented to us. I'd like to understand your charitable wishes a little bit more before we get too deep down that road. And then the last thing we can do is what we would call advanced estate planning. This may or may not be needed. We should consult with your estate attorney before we get, again, too far down the road. But you could set up something called a spousal lifetime access trust for each other, a SLAT for short, and we will be able to move your higher growth assets into these irrevocable trusts. Irrevocable just means that we can't change it, even though we could probably put some flexibility language in there, use different states that allow us that flexibility, but it gets these assets outside of your estate. They can continue to grow. However, we would have to use some of your lifetime exemption or sell these assets to the trust. So Again, don't want to get too technical today, but wanted to present the idea to see how you guys feel about it. So I know we've gone over a lot today, and it's a lot of information to take in such a short period of time. As a recap, and where I think the focus should be for the next few months is first off, generating some more cash for you. You've got the installment note, and while we fully expect all those payments to be made, I don't want all of your cash flow to be dependent on that one thing. So why don't we go ahead, find a way to generate some cash, look at maybe financing your personal residence. As we get installment note payments, we'll have plenty of cash to make the mortgage payments on the house. And our office can easily handle reaching out to a few banks, seeing what they can do, get a couple of term sheets, and then having a follow-up conversation with you in about 30 days. We'll run different analysis so you can see how it impacts your cash flow, and then we can make a final decision then. Also, we need to focus on the estate plan. While your wills are a great start, there's still more to be done here. I think we should have a call with your estate planning attorney in the next 2 weeks to talk about some of these ideas, get their input, and form a game plan on next steps. Next, we can move into what we need to do on your insurance. Let's reach out to your agent. I'm happy to do that for you and talk about long-term care. Have them get us a few quotes. And then again, we can model those into your current cash flow, current estate plan, and make sure everything works together as one cohesive plan. And then also, we need to make sure your homeowner's insurance gets updated. You've got some exposure. If something were to happen to the home, we wouldn't want that. So let's go ahead and get that updated, get the vacation home updated, and then also have them confirm on the personal property how that is insured. Again, with the boat, we weren't provided a policy, so I'm not sure how that was insured. And then also on the collector's stamp, given the value, I'm not sure your homeowner's policy is the best place for that, or even if it would cover it. It's too big of an investment. You would hate for something to happen to it and have that value go out the door. Again, I can work with your insurance agent. They're the ones who referred us to you. They're great to work with, and we'll come up with a plan. And then lastly, we want to look at minimizing the taxes, especially the taxes generated by your installment note. I think if we can get a call set up with your wealth manager, then we would be able to look at the losses that are in your current account, see what we can do some tax harvesting, and hopefully be able to offset some of the taxes that have been generated by the sale of your company with the sale of this stock. I'd like to tackle, all of these things in the next 30 days. While they probably won't be completed, I think we can get a really good plan in place. We want to measure twice, cut once. So let's get a plan together and we can meet back in 30 days and go through these things. Just some other things that we need to remember is keeping an eye on your stock portfolio. We will, of course, do that. We can meet quarterly to go through that with your wealth manager just to make sure your wishes are still being attended to. And then also, as we're working through the estate plan, let's talk about your 401k and 403b accounts and if the rollover into a Roth IRA really makes sense. If it does, then we can handle the paperwork for that. At the very least, let's go ahead and update beneficiaries to make sure your wishes of wanting to leave these accounts to the kids is properly documented. Now, again, that was a whole lot to go through. Do you have any questions? Is there anything that we can go back through that you need a little bit more understanding on? Great. Well, I'm going to provide, again, I've got your action plan right here. I've got a copy of your balance sheet and cash flow statement ready for you guys to go. And I'll provide all of these documents via email as well. Feel free to go home, have a follow-up conversation together, and we can always schedule another call or meet in person to go over any questions. One thing I want to end with is that you guys are doing great. You've worked really hard your whole life. You've built up a great balance sheet. You're going to be taken care of, and now we just need to maintain. Thanks for coming in today. I appreciate it. You guys have a great day.